From our studios in Scottsdale, Arizona, welcome to Retirement News Online. You can find out more at retirementnewsonline.com. And today we're talking about tax planning. You probably know that taxes don't retire when you do. In fact, they often become one of your biggest controllable expenses. Now, smart advisors help clients reduce lifetime taxes, avoid surprises, and create more efficient income in retirement. Joining us here is Jeremy Nelson. He's founder of Element Wealth in Jackson, Mississippi. And I guess we'll start talking about planning of withdrawals, because when you start taking income, I think a lot of people expect they get into retirement, hey, we're going to get into a lower tax bracket. Often not the case, and then income from different sources can change that dramatically.
Yeah, I think that there's the initial phase of retirement where we do get a little bit of a reprieve, right, because we haven't hit that required minimum distribution age yet. But all of a sudden, as we get a little bit older and we start having to tap into those IRAs, or we hit that required minimum distribution age, and now we have to start taking from the IRAs, a lot of people end up being surprised by where they fall in the tax brackets. Now, this leads to some real issues, because it's not just that you might push into higher tax brackets. It could affect IRMA surcharges, so what you're paying for Medicare. So there's a lot that you need to pay attention to.
And then you talked about the RMDs, or required minimum distributions, with now start at age 73. I think a lot of people don't even realize that those things actually increase over time.
Yeah, well, that's it, right? So if you think about the RMD, what is it? Well, it's basically the government looking at what your life expectancy is and then forcing you to try to take it out over time. Now, obviously, hopefully your assets grow a little bit quicker, so you're not going to completely exhaust it. But really what's happening is that every year you're a year closer to the end in their table, so they make you take a higher percentage out. So if all of a sudden you're getting into your 80s, next thing you know, it's a very significant hit that you're taking.
Here's a question, just between you and me, and I've just often wondered this because I've talked to so many financial professionals like yourself. So when the government figures out Social Security COLA, every year, the cost of living adjustment, which is designed to increase, do you think they ever go back and go, what if we put in 2 more percentage points? It's going to boost people's income and put them in a higher tax bracket at some level. Do you think that's part of the computation?
I'm not sold they're that savvy. I think they kind of use the lowest number that they can use, because they've got a pretty big deficit they're trying to deal with right now.
Probably true. So let's talk about Roth conversions. Taxes are essentially, quote unquote, on sale now, in one sense. So when you think about a Roth conversion, it would make sense that for a lot of people to at least consider that. When is it a good idea and when is it not a good idea?
Yeah, so I think that everybody should at least be considering Roth conversions. Now, whether it's right or not is going to depend on what the math tells us. But the way to look at it is, let's say I'm 65, I've retired, I've got a little bit of money that I'm going to use outside of qualified retirement plans. So I'm going to kick the can down the road on this taxation. Well, now, I could have filled up that 12% bracket or that 22% tax bracket. If I don't do it in that year, it's gone, it's expired, right? I'm never going to be able to use that low tax rate again. And if all of a sudden I'm getting down into where I have required minimum distributions and now I'm stuck at the 32% tax bracket, well, I really missed out on an opportunity there. I think that people get so focused on taxes in that one given calendar year that they forget it's about your taxation over the life of your retirement. And just look, the reality is the government's pushing $40 trillion in debt. Interest on the debt is $1.2 trillion, right? So you want to know what $1 trillion is? Yeah. Go back to Jesus' birthday, spend $1 million a day, and you're still not there.
Wow.
And we're spending $1.2 trillion, right, on interest on the debt. So to sit there, and I think you made an interesting point there, that taxes are on sale today. Yeah, I mean, I would make the assumption myself, if I'm planning, that I don't think tax rates are going to be lower in the future. So if I've got a window where I do have some lower brackets, I want to use those up.
Mm-hmm. And going back to this question, and we assume taxes are going to go up, but we have the possibility of policy changes at any given moment based on what we see in Washington these days. How do you stress test a retirement plan from a tax perspective, just to account for these things that could happen and when?
Yeah, so I think that, you know, we always run off the assumption, and our software runs off the assumption that that it's going to expire and revert back, right? So that's kind of the hedge as we're building out our plans, as we're saying, you know, hey, if it stays here, great, that's gravy, but let's assume that it's not going to.
And then finally, real quickly, I would, from what I've seen, and it appears in most cases that the average person is not doing any tax planning. They're working with an accountant or a CPA, which is fine, but are not really aware of how much increase in cash flow can happen from good tax planning, but also, you know, especially with people with large amounts of assets, how vulnerable they are to paying way more taxes than they have to. So what's your message to people out there right now? I mean, how do they know if they're working with the right advisor?
I mean, the right advisor should be having a conversation with you about your long-term plan. And it's about optimizing what you do. Ultimately, right, in a lot of cases, something like a Roth conversion isn't going to impact whether or not you're going to be able to retire. But what the big difference is how much money is going to go to your kids versus the government. You want the government to get more? Don't think about Roth conversions. If you want the government to get less over time, think about Roth conversions.
He's a radio host. He's the founder of Element Wealth in Jackson, Mississippi. This is Jeremy Nelson, ladies and gentlemen. Jeremy, thank you so much.
Thanks for having me, Scott.
And thanks for watching Retirement News Online. We'll see you next time.